Welcome students to the series of lecture on fixed income. And in this session, we are going to continue the discussion on callable and putable bond. And the discussion would be around the duration and convexity of callable and putable bond. In the last session, we introduced callable bond and putable bond in the series of lecture of fixed income, where we said that in callable bond, the bond issuer has a right to buy back the bond at a predetermined price. And in the putable bond, the bond buyer has the right to sell the bond back to the issuer at a predetermined price. So, callable bond is a bond where the flexibility or the optionality is at the issuer's hand, and in the putable bond, it is at the buyer's discretion. Now, we understood the callable bond, we understood the putable bond, but now today we have to focus on the price yield curve, and based on the price yield curve, we will determine the duration and convexity nature or the characteristics or the feature of the callable and putable bond. So basically, when we talk about the price yield curve, then what we talk about the price yield curve? We talk about the duration, which is the slope. We talk about the convex nature of the price yield curve. So actually, we are talking about price yield curve, but specifically, we will call out duration and convexity. Okay. So let's start with our first example on the callable bond. So in callable bond, we have face value 1000, coupon 6%, frequency annual, maturity is 3 year, and it is callable at 1050. Now, so you understand. This bond, if this bond would have been a normal bond and there is no callable feature, then this would be the price yield curve. If the interest rate falls, the bond will rise at a higher rate. And if it interest rate rises, then the bond price will fall, but at a lower rate. And that's why we love convexity. We discussed that in the convexity session. Okay. But there is a callable feature. The callable feature is to help the bond issuer, where the bond issuer can buy back the bond whenever the bond issuer feels like. But the question is, why an issuer will call the bond at the first place? What is the incentive? Why an issuer will call a bond? What is the incentive? The incentive will be only if in the market the interest rate has fallen. Why? Because understand, see, the issuer has issued a bond of coupon 6% and assume that in the market, the interest rate is also 6%. And that's why he issued the bond at 6%. So he has a liability to pay 6% of 1000, 6% of 1000, 6% of 1000 annually. But if in the market interest rate has fallen drastically, he can issue a bond with a lower interest rate or lower coupon, maybe 3%, 2%, 1%, 4%. Yes? So he can call the bond and now reissue the bond at a lower interest rate. And it will benefit the bond issuer, not bond buyer. It will benefit the bond issuer. So a bond will only be called by the bond issuer if the interest rate has fallen or falling. Otherwise not. And that is bad for the bond buyer because I'm holding the bond. If interest rate is falling, it means that the bond price is rising. Bond price is rising. But it won't rise further because it is callable at 1050. So bond has a right to call the bond at 1050. It means that the bond price will never ever rise beyond 1050. Because if interest rate is falling and if you calculate the interest rate at a lower interest rate of say 4%, 5%, if it is more than 1050, say 1100, say you calculated at 4%, the bond price came to 1100. But the bond issuer will come and buy back the bond at 1050. So why anyone on the planet will buy the bond at 1100? Nobody would. So can I say because of this callable feature, the price of a callable bond is pegged at 1050. It cannot increase beyond 1050. Okay. So if I calculate the bond price for 6%, 7%, 8%, 9%, it will behave like a normal bond because the interest rate is rising. If interest rate is rising, bond issuer is not afraid of interest rate rising because he has issued the bond at 6%. In the market, the interest rate is 7%, 8%, 9%, but he is sitting at a lower liability of 6%. So he's happy. So it will behave like a normal bond. So if you do the valuation at a higher interest rate, which is 6%, 7%, 8%, 9%, there won't be any change in the valuation. So the price yield curve will be very similar to as it was in the normal bond. But if it is 5%, now we have to think very carefully. If it is 5%, we have to calculate the bond price and see if it is above 1050 or below 1050. Let's see that. So second clear work, second clear TVM. 1000 FV, 3N, 5 I by Y, PMT is 60, compute PV. 1027. So bond price is 1027 at 5%. Now the question is, will the bond issuer will come and buy back the bond at 1050? No, because the bond price is only 1027. So he will not come and buy back the bond at 1050. Why he will buy back something which is trading at a lower price at 1050? Even bond issuer is smart. So it will not be called because currently the bond buyer is not thinking that it will benefit himself. So therefore he will not buy back the bond. But what at 4%? Let's calculate at 4%, 3%, 2%. Let's see when it is a right decision that I'll buy back the bond. So 4 I by Y compute PV 1055. 1055. At 4%, the bond price is coming as 1055. But we all know that the bond issuer can buy back the bond at 1050. So anyone in the market would be ready to buy this bond at more than 1050. No. So it will get pegged at 1050 at 4%, 3%, 2%. Rest, apart from that, apart from that, this bond will behave identically to the normal bond if the interest rate is greater than the value of say 4.1% or 4.2%. Let's do this. Let's do this. Let's find that break-even interest rate. So PV is 1050 negative. That's my PV. Compute I by Y. So at 4.1917, if interest rates start falling beyond 4.19%, then it will get pegged at 1050. The bond price will not rise. Is it a good thing for a bond buyer or not? It's a bad thing because we love convexity. Why we love convexity? When the interest rate falls, the bond price rises with a very higher rate. There is no convexity. This is a positive convexity. This is a flat line. Should I call it as negative convexity because I'm hating it? I love convexity. I love positive convexity because the bond prices rises at a higher rate than the bond prices fall for the same change in interest rate. That is convexity. I would hate it. I hate the callable bond, and that's why the valuation of the callable bond or the value of the callable bond would be lowest in all the bond. Perfect. And the convexity is going to be negative convexity. It's not a positive convexity. What is a positive convexity? The positive convexity is a feature of any bond where the bond price rises at a higher rate than the fall for the same change in interest rate. That's not happening. For a normal bond, we always have positive convexity. Normal bond is the benchmark here, so I'm writing it as benchmark. What is happening to the duration? See, this is flat. This is flat. So if interest rate start falling, the duration will not be rising. We discussed that duration is the slope of the price yield curve when we talk about the normal bond. And the steepness increases. The steepness increases as the interest rate decreases. But actually here the slope is what? Zero. Flat. Tan theta is what? Tan zero. That is zero. So the duration for the lower interest rate will become 0. Duration for lower interest rate will be 0. Here it is benchmark, so I'll not talk about it. Let's talk about putable bond. Putable bond. Again, I have taken the same feature, same characteristics as face value 1000, coupon 6%, frequency, annual maturity 3 year. But it is putable at 950. It is putable at 950, and we are giving the right in the hand of bond buyer that they can sell the bond back to the issuer whenever they feel like at 950. But think about it. Why would you or a bond buyer, a bond investor, will sell the bond back only if the interest rates are rising? Why? Because currently this is giving me a coupon of 6%. This is giving me a coupon of 6%. If I get my money back, I can put that money at a higher interest rate. I have purchased this bond when the market interest rate was 6%. And that's why coupon 6% felt good to me. But now the market interest rate is 15%. Coupon 6% is useless for me. So I want to reinvest my money at a higher interest rate. But I don't want to get penalized when I buy back the bond from the market. So therefore, I'm getting a good feature that you can buy back the bond. Sorry, you can sell back the bond at 950 to issuer directly. You don't have to worry about the price yield curve. You can directly sell it back to issuer at 950. See, understand what I'm trying to say. This bond has certain feature. Okay. Say at t equal to 0, the interest rate was 6%. I bought this bond at 1000. Next day, interest rate went to 15%. If you discount all the cash inflow, it will come a very low value, say 500 rupees only. Okay. So I will not be able to sell the bond in the market at a good price. I bought it at 1000. I have to sell it at 500, which is not good thing for me. So a feature which was given that if the interest rate rises drastically, you can sell the bond directly to the issuer, not in the secondary market, directly to the issuer at 950, which is a good thing for us. So when the put feature comes into action, when the interest rate rises, when the call feature comes into action, when the interest rate start falling. So if the interest rate is 4%, 5%, 6%, I'm not worried about it. So for 4%, 5%, 6%, or even 2%, 3%, the putable bond will behave like a normal bond. The story starts if the interest rate in the market start rising, say 7%. So at 7%, let's see what would be the value of the bond. So we'll do second clear work, second clear TVM. 1000 is FV, PMT is 60, I by Y is 7, N is 3, compute PV. It's 973. It's 973. So at 7%, the price is 973. So if I sell this bond to anyone, they will buy at 973. That's fine. It's not 950. And even why would you sell this bond at 950 to issuer if you can sell it in the market at 973? You won't. So at 7%, there won't be any impact. But let's calculate at 8%. 8 I by Y compute PV. 948.45. 948.45. If I'm aware that the bond price is going below 950, I will directly sell it to whom? To the issuer. So I will sell it at 950. At 9%, it would further decrease, but I'll sell it at whom? To the issuer at 950. So beyond this, it is flat, which is good thing for me. The bond price is not falling that much as we are expecting. It is better than convexity of a normal bond. So you can say it is more positively convex. More positively convex. I love this feature as a bond buyer because the bond price cannot fall below 950. And actually, if you are interested in finding that interest rate, you can put 950 negative PV compute I by Y at 7.9380%. At 7.9 380%. Beyond this, the price of this bond would be flat 950. Now, as a buyer, you would love this bond even better than the normal bond. So it will have highest value among all the three. The duration for higher interest rate, see, duration for higher interest rate will be zero. It's flat. Tan theta would be zero. Slope would be zero. It is flat, horizontal. Wherever you have horizontal line, the slope is considered to be zero. Whenever it is vertical line, the slope to be considered as infinity. We know that. Okay. So with that, we have covered duration, convexity, and also valuation of callable and putable bond. Okay. With that, we'll end the session. Thank you. Have a nice day.